Millions of dollars in the global chemical trade move on a knife's edge, dictated by fractional price shifts that happen daily. On August 11, 2026, a new global feedstock pricing tape dropped. This specific dataset is the absolute baseline. It dictates the raw material costs for virtually every sector of global manufacturing. Looking directly at the raw feed, you can see how dense it is. To the untrained eye, it is an unreadable wall of chaotic code. Hidden within this block of text are three distinct layers of fragmentation. You have varying geographic hubs, mismatched currencies and weight measurements, and complex shipping Incoterms. For a procurement desk, the operational problem is severe. They must parse this information fast enough to execute a trade before the market shifts. Mastering this daily tape allows a desk to instantly map global trade pressures and identify fleeting arbitrage windows. To extract actionable intelligence from this raw data, we first have to isolate it into the world's three major petrochemical hubs. This map shows our three primary theaters of operation: the U.S. Gulf Coast, Northwest Europe, and East Asia. On the U.S. Gulf Coast node, pricing relies on cents per pound and free delivered, or FDGC, terms. Panning over to the Northwest Europe node, the market operates in euros per metric ton, using delivery terms like CIF, cost, insurance, and freight. Finally, in the Asian theater, the standard shifts again. Here we track US dollars per metric ton, largely utilizing CFR and FOB shipping terms. Next to each of these baseline prices is a number in parentheses. This is the price delta, the daily upward or downward price movement of that specific asset. By comparing these localized price deltas against one another, we can visualize exactly where global supply is choking and where regional demand is surging. Standardizing the board turns a static list of prices into a dynamic map of regional trade flow and supply-side pressure. Naphtha is the foundational hydrocarbon building block. It is the primary raw material from which the entire Asian petrochemical chain is cracked. This map isolates the August 11 baseline price for naphtha, trading at CNF Japan for $810 per metric ton. That is a high initial cost, but the focus is the delta. The tape indicates a massive single-day upward surge of plus $45. In physical, operational terms, a $45 spike represents a severe, immediate cost-push pressure, slamming straight into Asian cracking facilities. This sudden spike in raw material costs threatens to obliterate the operating margins of downstream producers. The survival of these regional producers now depends entirely on whether they can successfully pass this $45 cost down the chain to their buyers. This localized input shock sets the tension for the entire trading day. We now have to observe whether the downstream derivatives will absorb the blow or buckle under the pressure. Moving one step down the chemical value chain from naphtha, we look at propylene, a primary olefin used globally. In a perfectly efficient, homogenized global market, propylene prices would generally trend in tandem across all regions. This map illustrates U.S. Gulf Coast propylene data, establishing upward momentum with a 42.05 cent baseline and positive delta. Contrast this with Europe. CIF and FD prices in Northwest Europe sit at 9.35 and 10.35 euros, both showing a €5 drop. Concurrent softening of CIF and FD pricing indicates weak European demand. Pivoting sharply to Asia, we see how propylene reacts to the naphtha shock. China is up $35 and Korea is up $15, heavily outperforming Western markets. This Asian propylene surge connects directly back to the naphtha shock. It proves that Chinese and Korean producers are successfully passing their raw material cost inflation onto their buyers. This divergence creates an immediate arbitrage opportunity. Traders can now look at moving cheap, unwanted European supply toward the expensive, hungry Asian demand vacuum. The propylene tape proves the global market is deeply fractured. On August 11th, geographic location entirely dictates a trader's profitability. Ethylene is the other major primary olefin. Based on propylene's performance, we expect it to mirror that strong upward momentum. Western ethylene markets align with expectations. US ticks up to 25.13, Europe drops €5. But shifting to Northeast Asia reveals a glaring anomaly, a massive downward collapse, plummeting $30. Meanwhile, neighboring Southeast Asia suffered only a minor $5 drop. These figures define a classic margin squeeze. Input costs for naphtha soared $45, but output prices for ethylene crashed by $30. The reality for Northeast Asian cracker operators is brutal. They are trapped between rising costs and collapsing demand, bleeding capital on every ton produced. While Asian propylene buyers accepted the cost hikes, Northeast Asian ethylene demand broke under the pressure, revealing a dangerous fracture in the regional economy. The ultimate litmus test for market health lies at the very end of the line, downstream derivatives like aromatics and the polyester chain. Reviewing the styrene market in Asia, it is barely clinging to a marginal $5 gain, failing completely to match the energy of upstream naphtha. This chart isolates the specific raw materials for polyester manufacturing in China, PTA and MEG. Look at the contradictory pricing action within the polyester chain itself. PTA is dropping by $5, while its sister product, MEG, jumps by $15. This mixed, confused recovery at the tail end of the value chain is a clear indicator of deep uncertainty among end consumers. The technical analysis for August 11 reveals a market choking on upstream supply costs that downstream consumers are simply refusing to digest. The operational reality is harsh. By the time a human analyst manually maps these global spreads, the arbitrage window has completely closed. Surviving in this incredibly volatile environment requires extreme, high-frequency data processing and fully decentralized decision-making capabilities to stay ahead of the curve. The solution to this latency issue is integrating AI-powered chatbots directly into ubiquitous messaging platforms. The specific intelligence hub powering this daily data synthesis is Polymer Bazaar. A procurement manager simply sends a WhatsApp message with the keyword feedstock to a dedicated node at +91 9374 624 365. The AI instantly interprets the query, parses the entire global pricing tape, and delivers the synthesized intelligence in under 5 seconds. In a commodity market defined by brutal regional margin compression, a competitive advantage depends on the automated speed at which a trader can interrogate raw data.